Tax departments no longer rely on manual sampling. They ingest millions of financial data points into continuous risk selection algorithms that automatically flag discrepancies. These algorithms aggregate information from the annual information statement, the taxpayer information summary, specific high-value transactions reported through the SFT, and all PAN-based banking data. When that overlapping data reveals cash deposits that do not align mathematically with your declared income, the immediate administrative response is a Section 143(2) notice for scrutiny assessment. Receiving this notice does not mean a penalty is finalized. It is a procedural requirement initiating a detailed verification of specific items in your return. The tax department evaluates each deposit based on its specific nature and source, requiring the taxpayer to substantiate the origin of the funds before any tax liability is determined. Under the Income Tax Act of 1961, Section 115 BBE applies a severe, punitive tax rate to any cash deposit you fail to properly explain. For future assessments governed by the Income Tax Act 2025, that exact same punitive taxation mechanism is applied under Section 107. Both the legacy and new statutes place the legal burden of substantiating cash credits squarely on the individual taxpayer. Verbal explanations during a scrutiny assessment hold no legal weight. Avoiding these additions requires a structured, mathematically sound documentary defense. Before submitting any response to the assessing officer, you must construct a complete internal record of your financial position. This factual matrix requires collating your ITR, your computed balance sheet, your capital account, and, crucially, a fully reconciled day-wise cash book. The officer evaluates bank credits through a four-part framework. First, prove identity, showing who deposited the money. Second, establish nature, explaining the business purpose behind the deposit. Finally, prove the source and supply evidence, tracing where cash originated with contemporaneous documents. If your defense fails to satisfy any of these four quadrants, the assessing officer has legal grounds to treat the deposit as unexplained income. The origin of the cash completely dictates the strict paper trail you must provide. You cannot use generalized documents to explain specific transactions. This grid maps the most common deposit type, business receipts. The officer expects direct continuity between operations and the account. To substantiate this, present GST returns, daily sales summaries, and trace the specific deposit to a recorded cash book entry. The documentary requirements shift heavily when explaining cash derived from agricultural income. You must prove the agricultural activity actually occurred by submitting land records like the Adangal or Pahani, explicit crop details, fertilizer receipts, and agricultural sale bills. Explaining a deposit as a gift or a cash loan from a third party triggers the highest level of scrutiny. Substantiating third-party cash requires verifying three distinct elements: the donor's identity, their financial capacity to provide the funds, and the genuineness of the transaction itself. Satisfying this requires producing the donor or lender's PAN card, copies of their personal tax returns, and their bank statements showing the withdrawal. Without precise documentation, taxpayers often trigger automatic rejections. The most frequent fatal errors include claiming large cash gifts without donor income proof, submitting backdated ledger entries, and providing explanations that contradict previous tax years. The objective is simple. The assessing officer must be able to trace every rupee back to a verifiable document without relying on your verbal assurances. Documentary evidence loses its defensive value if the underlying accounting logic is mathematically inconsistent. The fastest way to guarantee an addition to your taxable income is presenting a ledger with a negative cash balance, or claiming a deposit that mathematically exceeds the cash you had available on that date. This formula illustrates the mandatory solution. You calculate your opening cash, add documented cash receipts, subtract your cash expenses to arrive at a definitive closing cash balance. The exact closing balance calculated immediately prior to your bank trip must mathematically match or exceed the amount of cash you subsequently deposited. This split screen details a highly audited scenario: cash that is withdrawn from an account, held by the taxpayer, and redeposited at a later date. You must map the exact timeline for the officer, identify the initial withdrawal date, calculate the exact number of days the cash was held, state the purpose for holding it, and log the final redeposit date. If your business involves multiple, continuous cycles of withdrawing and depositing the same cash, you apply a formal accounting framework known as a peak cash statement. By charting the high watermark of cash available at any point during the year, a peak cash statement mathematically proves that a single pool of money circulated instead of being treated as multiple instances of untaxed income. When you present a pristine, temporally accurate ledger reconciliation, you remove the assessing officer's ability to classify the deposit as unexplained money. Practitioners managing scrutiny assessments are currently navigating the transition between the 1961 Act and the Income Tax Act 2025. This table maps legacy provisions for unexplained income to their positions in the incoming tax code. Section 68, Unexplained Cash Credits, translates directly to Section 102. Section 69A, covering unexplained money and assets, maps to Section 104. The 2025 Act also simplifies the language, replacing the dual concepts of previous year and assessment year with a single unified tax year. When drafting your responses, you must bifurcate your statutory citations based strictly on the year under scrutiny to prevent procedural confusion. While the section numbers have been reorganized, the underlying mechanics of scrutiny and the demand for absolute substantiation remain consistent across both statutes. You present your finalized defense to the tax department using a deposit explanation sheet. This document isolates each transaction, logging the date, the exact amount, the source of the funds, the relevant book entry, and the cross-reference to your evidence annexure. It operates as the master index to your dossier. It immediately guides the assessing officer to the specific invoice, bank statement, or ledger page required to close the inquiry. The judicial precedent is consistent on this point. Courts repeatedly rule that an assessing officer's suspicion cannot override objective, contemporaneous documentary evidence. Defending a Section 143-2 notice is not a narrative debate. It is an exercise in assembling a verifiable, mathematically continuous proof that leaves the department no legal authority to classify your deposits as unexplained income.